everyone. Welcome to another edition of our Mosaic podcast. You are listening to the February edition, the month of love.
Oh, wow, yes, it is a month of love.
You are joined by myself, Mandisa Zavala, the head of asset allocation, and the very beautiful, stunning lady in red, well, in white with red lipstick, our chief economist, Mpho Lepiane. How are you doing?
I'm good. Okay. I guess I'm getting into, the
Easing
month of,
into it.
love, as you say.
Yeah.
Although in my world, Feb is budget month, I must say. Like, this Valentine's
True.
Day.
True.
It's like, oh, yes, yeah.
Yeah. So we're going to talk about that. We're going to talk about budget.
Yes.
But I'd love to hear how the month has been for you.
Yeah, I mean, last month when we chatted, we talked about how, 2026 has just started off with a bang. But the other thing we did talk about is how the monetary policy easing cycle is likely nearing an end, and that our expectations are that the Fed will be able to ease by an additional 50 basis points in the second half of the year. So last week's decision by the Fed to keep the policy rate unchanged was unsurprising. It was in line with our expectations. But I think, a more significant development in that regard was the announcement that President Trump has nominated Kevin Warsh to succeed Jerome Powell as the Fed chair, right? So, the immediate implication and key question for us is whether this alters the course of monetary policy, particularly in the near term. The short answer is no.
Okay.
And the reason why we say that is because if you think about the Federal Open Market Committee, it is a 12-member committee.
True.
And decisions are made by consensus.
Yeah.
It's not unilateral decision being made by the Fed chair, right? So while Kevin Warsh has expressed preference for the Fed balance sheet to be reduced and for interest rates to be cut a lot more aggressively, getting consensus on these views may prove to be challenging, particularly in the near term, especially given the current macroeconomic conditions, right? So if we look at the U.S. economy, it's still running hard, around 2%. Inflation is still above the Fed's target, and we're only expecting that inflation is going to peak in the second quarter. So, based on that, our assessment of economic conditions are still supportive of, the Fed only being able to ease in the second half of the year. The broader implications, I think, over the medium to long term, yes, we do acknowledge that the Fed chair can have greater sway and greater influence in terms of, the monetary policy direction. I think the longer term implication and major consideration for us is whether the Fed independence is going to remain intact. Remember, we do have the Lisa Cook case, which remains ongoing. Jerome Powell was also issued with subpoenas. And, what we will be watching for is whether there is a favorable ruling in favor of Trump to fire Lisa Cook or not. And, we do think that if the court rules favorably in Trump's favor, that definitely opens the door for more drastic changes in the 100%. Fed's leadership, right? And certainly brings the concern around Fed independence back to the table. But, for now, in the short term, we're not expecting any major drastic change in near-term policy rates, still expecting that the Fed will ease by about 50 basis points in the second half of the year. I mean, so what I found quite interesting, I must say, was the market reaction to the news, right? So the fixed income market reaction was, somewhat muted, and you can expand further, but more surprising was the outsized reaction in gold markets, and it's it's not immediately always clear. Like, it's not immediately clear. I'd be keen to hear your take in terms of why we saw that reaction in the gold price, and essentially what your outlook is going forward.
So my initial takes, and I think you kind of speak. You've elaborated on the story, so we can now appreciate what it actually is. The reality is, when markets get information, they react to it with a lot of emotion. But to your point, bond investors are known actually in the investment world as the cleverest of investors.
Interesting.
If you could put it that way. So the bond market is seen as a lot more sane. It takes in information. It takes time to, not necessarily always takes time to respond. If something is of importance and it happens at that moment, it will respond quite adversely. But it also is one where we do see measured responses in situations like this. And the reason is because at the time, what was topical and what was being printed within newspaper articles was that historically we've known Kevin Walsh as someone who has been a hawk. He's been quite critical of the Fed. He was part of the Fed in the past, but since then he's been quite vocal, rather, in his stance of, he's against QE. He's not for the concept of coddling the economy. And by the way, I'm paraphrasing if you are a Kevin Walsh fan, but he has been one that has advocated for lower levels of inflation. He's not a fan of high levels of inflation. And so when that became printed out, or that became topical in newspaper articles, the equity market, which does tend to be a lot more emotional, not stupid, but more emotional, reacted to that and said, wait, we're probably about to experience an environment where, we see a reversal of what has happened. We don't necessarily see interest rates coming down. Or perhaps one may argue, another view might say that perhaps they were overly pricing in the fact that, now there's no longer any risk, and so we won't need gold. So I'm not sure which camp it is. I think it will become a lot more clearer as we go into the month, whether it was the first camp that drove it, and it seems as if it's the first camp that is more afraid of what Kevin Walsh as the Fed chair means, than it's the camp that is saying, we're behind the risk now, that we don't need things like gold. But where we stand right now is actually with the market a day later having recouped most of
As
the losses.
always.
Exactly. Just 24 hours. We have now gone back and the market is now up. I was looking at the South African resource numbers, which are very much tied to the gold price, also doing quite strongly, punching quite strongly in this first half of the day. We're not even at the end of the day. So it seems as if a lot of that noise is now being taken with, I guess, a pinch of salt. And, there's a realization that perhaps we need to be more nuanced about it. Like you're saying, this is a committee. It's not one person that's coming in to make a call on inflation. And to a large extent, his most recent remarks has been aligned to lower interest rates. So we don't know, right? Perhaps, like you said, in the short term, there's not much of a risk. But in the longer term, will we then see him come out with a bit more of a hawkish tone? That is yet to be seen. But I think on the gold, just to kind of close off that.
So sorry, before you go to gold.
Yes.
So, essentially what you're saying is that the proof of the pudding will be in the eating, in a sense that, we'll only get to see which way, Kevin Walsh actually stirs the Fed once he's, chair and in it and leading it for some time.
100%. And I mean, we were having our own internal discussions yesterday, and we're talking about how, we mustn't also forget that Powell was also a selection of Trump. Today you have him subpoenaed by President Trump, but the reality is it was Trump that put him up for this position, so we are now being graced with another Fed chair by Trump again.
So lastly on this point, what was quite interesting was, Trump's speech at WEF, right? He mentioned exactly that. Like, he himself is not convinced that Kevin Walsh is going to deliver on his agenda of, aggressive cuts in the short term, right? Yeah. He's like, these guys, when you interview them, they tell you what you want to hear, but once they get the job, they just do whatever. So even Trump is skeptical, and hence we have to wait for the pudding. Yeah,
we literally have to wait for the pudding.
Yeah,
but I think we have enough cushion, and I want to also preface, or rather end this discussion with looking at where we are within the global market space, because a lot of this happened on the back end of the month. But really, the majority of the month, the markets were actually up. We had good performance, strong outperformance coming through from emerging market regions. Overall, EM, excluding China, indices were up over 10% just for the 1 month. We had strong performance actually coming through from South Korea, which was up 27% for 1 month. And then on the DM side, the best performing market there was Japan, that was up over 6%. So very strong performance. The questions that we have been getting from clients is around this gold talk, to actually try to ascertain whether or not we're most likely at the peak, and we're probably going to go down from these levels where gold has now breached 5,000. It probably is coming down. And I think we've sort of communicated that we don't necessarily see the evidence of this. What we've said is, yes, these are highs. I think if you chart the gold line, historically through time, you can see that it's definitely a very high price. Breaching 5,000 is a big deal. But all of the fundamentals and structural things that have kept gold up still remain in place. There's still geopolitical tensions. You spoke about the Lisa Cook and Jeremy Powell issues that still linger, that we've yet to sort of see. All of those things are still going to cause markets to become jittery. We still have the uncertainty around policy in the US, and so no one really wants to buy the US dollar as a safe haven asset where you're just holding the currency, because that currency is weakening, but also you don't necessarily know whether or not tomorrow. Exactly, there's risks, that are seen with that, but also long-term credibility of interest, the credibility around central bankers still holding gold. It still stands. They've been vocal in saying, we use this as a diversifier of our own assets. We want to continue to hold it. And recently we've only just started to see retail investors also pick up gold in the same light. And I think all of that being in line, we're sort of saying, yes, we've breached 5,000, but we still think there's room for gold to continue up. The number now that everyone is looking at next is the 6,000 number, and some very optimistic individuals are talking about 7,000. And I think it's important also to highlight, and I'll close it here, that with that support for this gold price comes support also for our own commodities or our own gold miners in South Africa as well. Because when you look at a recent chart that was put together by JP Morgan, what you find is that if you just charted all of the gold miners in the world and you said which ones have the highest beta to the gold price, you actually come up with 3 stocks on the JSE All Share, on the South African Stock Exchange. The others are towards the Australian market. But that says when people are hunting for, yes, you're buying gold, but you're also hunting for opportunities that are aligned to this upward ticking price within gold, you probably are going to be looking at markets like South Africa. So very strong returns coming from there. Sorry, I know I've sort of shifted to SA. Maybe we can talk about South Africa.
I think that's a great segue into SA, and I think it continues to speak to that positive sentiment and positive momentum that we're still riding on. And I think I also just want to stick to the monetary policy theme as well. We also had the SARB MPC meeting last week, and they decided to keep policy rates on hold, which was also not surprising and pretty much in line with our view. We had communicated in a client note that, given the back-to-back cuts in September as well as November last year, the SARB is likely to prefer to hold and just observe that transmitting through the economy. We also flagged that the SARB will be quite wary of significantly loosening the level of monetary policy restrictiveness, given that services inflation is still running around 4%, right? So really not surprising. But in terms of the outlook, we remain quite upbeat, quite constructive, and we think there's scope for an additional 50 basis points worth of easing this year, likely 25 at the March meeting, followed by another 25 at either the May or July meeting, right? But certainly the SARB still has scope for further easing. The risk view, of course, is that if we do get an adverse inflation shock, the cuts could be pushed out.
Yeah.
But similarly, if we do get a positive inflation surprise, then the 2027 one cut that we're expecting could also be, front-loaded.
So, are there risks for an inflation shock? Are the risks material for an inflation shock?
Yeah, so what we're particularly worried about on the inflation side, firstly, is, developments in the Middle East, whether we'll get any military action there that could, lead to a disruption in oil supply. And we know that when oil prices do surge, that tends to transmit quite immediately to the consumer, right? Because immediately fuel prices increase. And whenever there's geopolitical tensions, we usually see the rand weakening as well. Emerging market currencies generally don't do that well in heightened geopolitical risk environments. So, it could be a double whammy, the currency weakening, oil prices also surging, and then leading to higher fuel prices, which would then be inflationary. But we are also worried about food prices as well, given the ongoing foot and mouth disease, and meat prices continuing to tick higher. So, we continue to monitor that closely, and hopefully we'll get a resolve on that front.
Yeah. Okay. At least that it seems as if right now the lid is on top of that, but it could bubble anytime. You never know.
You never know, right? As we always say, if we knew.
I think perhaps I can just comment, very brief comments, I think, on the South African market. I think on our side, we're still seeing quite the positive momentum you spoke about from an economic perspective. We're also seeing it in the markets. By way of numbers, we saw good performance coming through from our South African bonds for the month. Those were up around 2%, which was our SA bonds. They outperformed ILBs, which were up 1.3%. And of course, you were better off in bonds rather than cash, because cash was just up about 6%. But really, the glory is always taken by our stock market, because that continues to sort of still skyrocket higher. We had 13% coming through from SA resources just in general, and that actually was camouflaged because the JSE All Share was up about 3.7%, so just under 4%. But the biggest contributors there were the South African resource sector, telecoms, and even South African mid-caps. And so it's very difficult to talk about South Africa because really there's nothing to say.
It's like we're not used to telling a good story.
We're not used to telling a good story that it's just tough to write about SA now. But it's a good thing. I think, not having news, no news is good news, nowadays. Because I do know there's going to come a time where we have a lot of news, which is the second half, where we have elections. And of course, we have the budget coming up. Maybe you want to share some brief thoughts on that?
Yeah, so interestingly, the year-to-date budget numbers, so that is April to December, April 2025 to December 25 numbers, show that Treasury likely has a good story to tell at the upcoming budget. Because we've seen modest expenditure growth and some slight overperformance on the revenue side. So indications are that the main budget deficit could come in around 0.2 to 0.4 percentage point narrower than what was estimated at the time of the medium-term budget policy statement. So really continuing to ride that positive story, positive momentum, right? Certainly from my side, I'm hoping there'll be no budget drama. No three budgets again. But I say that because there are lingering questions in the budget, right? So like, for instance, Treasury still has that 20 billion in revenue measures that they still kept in the baseline numbers. So they still need to make a determination in whether they're going to keep that or they're going to remove it, given the better performance this year, right? We think that tax increases are unpalatable, given that it's an election year. But they do have other off-ramps, right? So there has been, talks around a online gambling tax, which could potentially bring in about 10 billion. So, they do have some room to maneuver.
My goodness, are people gambling that much?
Yes.
Oh my gosh, okay.
Unfortunately.
Sorry if you're a gambler.
Unfortunately.
Oh my word.
Yes, it's a very potential lucrative.
It's a billion rand industry.
Source of revenue.
Yeah.
So I mean, something for the National Treasury to work with. But overall, we continue to expect a good news budget in line with our expectations. As we discussed last month, that we're likely to see a further improvement in the fiscus, which could eventually lead to further rating upgrades, right? So that pretty much remains on track.
Yeah.
And that's all.
Sure.
For today.
Yes. Thank you for that comprehensive update.
And also thank you for unpacking those market trends and our view on gold, especially that. It was a great discussion. Thanks for joining us, and see you next time.